Hey guys, I've gotten a lot of requests and interest and actually just looking at my monthly dividend paying portfolio. So for this video, I'm going to do something a little different. Instead of doing a portfolio updates and revealing to you what kind of swings I'm in, any new buys I've bought into that I want to do as a long-term trade, I'm actually going to just focus this video on my passive income portfolio because I think if you see my videos in the past, I don't put enough time into that. I usually go through it quite quickly. As of like, I already assume that you guys know what I'm talking about, but actually, looking back in my videos, I realized I really haven't talked about it much. So if you're very interested in just the monthly dividend, passive dividend kind of investing, then this video is the one for you. I'm just gonna focus on that. All right. So before I get started, I'm just gonna tell you a little bit of background. Most of you who are watching this channel for quite some time don't know this about me, but actually, the biggest turning point to getting to where I am now in terms of my portfolio and how much I've been willing to invest in it is actually with dividend investing. I started investing back in 2014. This is the time where it was a couple years after my college, and I had enough money that I can put on the side, and I could confidently say that I don't need to use that money for some time, and I'd rather invest it. And since 2014, I put it in Tesla and just forgot about it for a couple years. By 2017, 2018, I took that Tesla out, made good gains, but as you see Tesla now, it's just been growing and growing and growing, and I wish I never took it out. So in that sense, I've always told my viewers that I'm very experienced with Tesla, just because I've been following it. But that's the actual story. And there was a couple years in between after 2017, 2018, until COVID, that I really didn't touch Tesla stock. 2021 was when I started getting into passive income investing. I think the biggest draw about that is that when you have monthly dividends paying you something every month, it actually could be something that can pay for your lifestyle. In the past, I would have to earn a salary and take a portion of my earnings from my job to put it into a car payments, something like that. But slowly, as I realized when I was building out my dividend income portfolio, is that actually the dividends I can earn monthly can actually just cover my living expenses. That's what really got me interested. So I remember in 2021, 2022, I dropped maybe 20, $25,000. It wasn't paying much. I believe like it was in the hundreds, probably like two, three, 400 range. I mean, I forgot the math. It was so long ago, but probably in that range. And at the time, like just starting off, it felt like a lot. Um, Especially the Tesla stocks that I bought in 2014. I was so young back then, like 24, 25, that um, the $25,000 that I put into my passive portfolio investing is nothing compared to that, much bigger. So earning three, $400,000 a month felt amazing. But I think it was really the end of 2023 that things started to change. So from 2021 to 2023, I put some money in, but I actually had quite a lot of cash on the side. There was probably like 70,000, 80,000, 90,000, something around that number, close to, six digits that I just never put into the stock market, even though I could and I had it. Because as you guys know, I'm actually quite a conservative investor. And that's probably why you're listening to the story about me starting with passive investing before I got into swing trades and all that kind of stuff. Um, so I wanted really like a proof of concept, and the $300-400 that I earned back in 2021, 2022 was it. And then 2022 into 2023, I probably put a little more money in. So I think by the time of end of 2023, I probably had maybe 50,000 in, 60,000 in, something like that. And that was a cumulative of the money I put in and also the profit I made. Um, but I think in December 2023, so back to the story, why did I start to scale up and put the rest of my money in and have as big as a portfolio as you see right now? I think it's just because I think it was the realization that, hey, in 2023, December, I actually made $10,000 just doing passive income trading since 2021, 22. But man, what a shame and so regretful because if I had dropped the whole $90,000 that I had since 2021, 2022 into the market, I could be earning, two, 3x this kind of money. So this really brings us to today. Starting in 2024, like the end of the winter of 2024 and the start of spring, that's when I really, really started to scale up and put the rest of my money into income trading. So bring us to today, how my portfolio is set up. Um, just a side note, this is the new look of Wealthsimple's platform, and I think it looks hideous. I don't understand why they had to make us take an extra step to get into our portfolio, but I guess they made us do that, and apparently somehow it was more beneficial. But, anyways, that's just me ranting. So today I have, as you can see, a total of about $311,000 invested, and this is my investment plus the profits. And my monthly dividend investing has now been just a third of it. So at $123,000, the TFSA that you see here is basically where I put all my monthly dividend stocks. And so if you look at the 123,000 in comparison to the 311,000, it's about one third of my portfolio. So today I'm just going to focus on that. One thing that you're going to notice about this portfolio, which only does monthly dividend investing, is that it's up quite a bit. 17% all time. So this is starting from back in on April 1st. So one cool feature you have about Wealthsimple is that if you go to all and then you start all the way, scroll all the way to the left here, it'll tell you roughly when we started. So you can see I probably, started the account April 1st, and it took up a couple of business days for the money to drop. And that time, I deposited $82,000. That's what the net deposit number is, how much money I put into Wealthsimple. Oh, by the way, you're at this point you may be wondering. I thought I earned $10,000 from 2021 to 2023. Where is that? Actually, back then I was actually investing on like with a brokerage from a bank called Bank of Montreal in Canada. So this is a transfer I did from Bank of Montreal on April 1st into Wealthsimple. So you don't see my history before that. But just know that the $82,000 I dropped in, $10,000 more or less or so was from earnings that I made when I was investing from 2021 to 2023. So, anyways, back to April 3rd, 2024. So you see that like my deposits is higher than my portfolio value, probably because when the money came in, it dropped about $1,000. But over time, as we go into May, the net deposit just slowly overtakes the portfolio value. At on May 1st, it was $86,400 to worth of net deposit, and then portfolio value has gone up to 86,000. By about June 5th, you can see that my portfolio value has finally overtaken my net deposits, about $4,000. Okay. Into July, you can see that my portfolio value is at 107,000. Whereas I only deposited $98,000 at that point. And then you can see that my net deposit doesn't really change as I go through August, September, in October because I'm not putting any money in. TFSA, you shouldn't really overinvest because then you're going to incur huge charges with the CRA. So I just let it sit, and every month, it pays me a dividend, and then I take that money and I reinvest it into the stock market. So I buy the stocks. I choose the stocks that I want to buy. I don't set it where because I know there's a setting where you can just like auto invest it. I don't really do that because, for me, because I follow the market so actively that I know which stocks I want to buy. So I just, every month when the money comes in, I go and invest that money. So, anyways, we're in November now, and you see that our portfolio value is, over close to $20,000 above our net deposit. By December, January, we hit this little bump here before we go up. So at this point, you see that I've put some money in. So we've gone from January 1st, 98,000 to 105,000, just because it's a new year and the TFSA allows us to make a new contribution. And It was pretty high at this portfolio. Maybe like the highest peak was January 2022. I have a investment of $105,000, and my portfolio value was 125,000, so I was up $20,000. But we've had a huge dip because of Trump and his policies, and now today we're up $18,000. So it hasn't grown much since January, but and then I'll show you what I'm holding and what how they're doing right now, and you'll see why that is. All right. Even though it seems like I haven't gone through much, I'm actually in a better position now than I was on January 22nd, because January 22nd was when the market was at its all-time high, and I had that number because all of my stocks were hitting and I had the best case scenario for all of my investments. I think that time Tesla was at its highest, Nvidia was at its highest, a bunch of the passive monthly stocks that I own were at its highest. So I felt at this point, like, unless everything keeps making all-time highs, there's no way that I could keep going up. Versus today, although I'm down about $2,000 from that $125,000 pinnacle, a lot of my stocks are not performing well. They're underperforming, and that's good. So that means that there's more room to grow. Okay, so I'm a better position now, because moving into the future, I think that there's a more likely chance that everything's going to go back up again versus when I was at all-time highs back in January. And when you're at the historical highs, all the only place it can go down is only one place it can go is down. All right. So having said that, let's actually go look into it. So currently, I'm holding about $6,000 cash. This morning, I was holding more than that, about 8,000, but I actually dropped a bunch of money into some new buys. And then before we look at the holdings, I'm just going to show you the $1,840 that I earned last month. So what's cool about Wealthsimple is I can filter. I can just go to type, and then I'll just look for dividends. And in the month of May, started on May 1st, YTSL paid me about $200. ETHY paid me 114. QQCL paid me 111. USCL 124. HPYT paid me about $930. And VHE paid me about, if you add these two numbers up, probably about $67. AMZH paid me 137. RS paid me 172. And if you add those all up, May was about $1,840. We're already into June now, and I'm already starting to get dividends again. So you see, like, the interval between my last monthly payout, May 15th, until when I get my new payouts is only about a week, right? Between May 15th, June 2nd, that's about 2 weeks time. And after 2 weeks, the old payments are done. Now I'm getting paid again, which is awesome. So June 2nd, I start getting paid in ETHY again, just like last month when May started. And it's basically the same stocks. I don't expect my June to be higher than my May. It's going to be lower for sure. The reason being, I actually took a lot of money out in May because I had a few stocks in this portfolio that just went all the way up. So the one I'm talking about is NVHE. So that's something that follows Nvidia's stock price. And because I was so up on it in terms of growth and dividend, I think I was up like $600 that I just sold it because, Nvidia was at a price point where I felt like it could go up or down. So I took that out. So you can see here that, I'm not capping or I'm not, lying about my dividends. I do make 1840 just passively by doing almost absolutely nothing with my passive income dividend paying portfolio. Okay, next so like I said, I was gonna show you what's in it. So currently I'm holding 1, 2, 3, 4, 5, 6, 7 stocks. Okay. I'm just gonna list them from my favorite to my least favorite. So my favorite two is gonna be USCL and QQCL. If you read them, these are both called, they both start with Global X Enhanced, right? Global X Enhanced, Global X Enhanced. The only difference is that USCL follows the S&P 500 market index. That's the top 500 US companies on the US stock market. And the QQCL is following the QQQ, the Nasdaq. That's the top 100 tech companies in the U.S. So they actually move very similarly. If you know about the market indexes, if you look at this graph, USCL, and you look at QQQs, QQCLs next, you see it looks about the same, right? It had very similar movements. You see that at the beginning of the market, it was, at a high, and then it dipped, and it went back up, and it went down, and then it went in the middle, right? Which is very similar to USCL. That's the beauty of Nasdaq and S&P 500. They move very similarly. They kind of follow or mimic one another. So um, if I were you, I could choose to just go all into USCL. I could choose to go into all QQQCL. What are the differences? Well, first of all, there's no differences in terms of company because they're under the same company. They're both managed by Global X, the same company. So in terms of like the product, they come from the same source, the same company. There's no differences in that. Okay, so management fees and stuff, there's not that much of a difference. But where the difference lies is whether you like SPY S&P 500 or QQQ. What the differences are. So QQQ is pure, not pure, but like mostly tech. So the tech companies in the U.S. have to do well in order for QQQ to go up. And because the tech companies make up so much of the stock market of the U.S., the SPY follows similarly. But where you're going to get differences is if all of tech goes down, but then let's say non-tech companies in the U.S. are going up, you will see the SPY performing better than QQQ. So maybe if that's something that scares you from investing in QQQ, maybe you can go into that, right? But on the other side, historically, since the 80s and 90s, the tech companies are what does well in the U.S. That's always been the U.S.'s one of their top industries for many, many years, and for years to come, since we're in the middle of the AI revolution right now, right? So if you like tech, QQQ is the one. But one advantage that QQQ has, the Nasdaq has over the S&P 500, is that the QQQ is definitely has better price action. So if you like price action, then you should go for QQQ. What that means is like, if the market is down and you bought in, the QQQ is much likely to, just spike back up when the market goes back up again, which is always good for like, getting in at a better price. Getting in a lower price, selling at a higher price. The USCL doesn't have as much price action. I think it basically just stays around the same because the bad companies also weighs down the good companies too. Whereas the QQ, when the companies are all doing well, poof, it kind of goes up. My third favorite here is HHIS. So those of you who have been following quite a bit consistently know that this is a pretty new one because I just bought it a couple days ago. And I want to talk about why I bought this one. So this one was on my radar since, winter. This is a relatively newer product that, just got rolled out maybe last fall. And as soon as it came out, I knew about it. So actually, let's just look on the date to see exactly when it came out. So we don't have to, I don't have to like trying to remember. Okay, so January 14th. So maybe not last fall, but maybe definitely like January 14th is close to the beginning of winter. That's when it was first introduced. And that was on my radar. I think the reason why I didn't buy it is because for me, okay, and this is, you have your own thoughts. You don't have to, agree with me. But for me, I like some tech companies and I don't like others. I like some Mag 7 companies and I don't like others. So when you look at HHIS, and that's what I'm going to do right now, I'm just going to quickly pull this up for you. Let's just look at HHIS, over the internet. So if we look at HAIS and we go on Harvest's website's company, we can actually see what their holdings are. Okay, so these are its holdings. Google, Eli Lilly, Microsoft, Nvidia, Amazon, Meta, Palantir, Tesla, Costco, MicroStrategy, Coinbase, Broadcom, Netflix, AMD. I like some of them and I don't like others. I'm neutral about Google. I like Microsoft. I kind of like Nvidia. I like Amazon. I like Meta. I like Palantir. I like Tesla. I like Costco. I'm neutral about MicroStrategy and Coinbase. I like Broadcom. I like Netflix, and I don't really like AMD. So I think initially why I did not buy into HHIS is because, well, why do I want AMD, um, Coinbase, MicroStrategy, and Eli Lilly? I really don't like Eli Lilly. So there was a bunch of stocks here I just didn't like. I thought maybe it'd be better rather than buying the whole basket that I just buy, specific funds. And that's why if you look back at my portfolio, there's specific funds that I like to buy. I like to buy Amazon, and I had Nvidia before, and I had Tesla before I sold it, right? But now that it's May and June, I have a different thought about this. I think I'm starting to like some of the companies more and more and more. So since that thesis I had in December, I've liked AMD more. I like Costco more. It's now at a better price. And I like crypto a little more. MicroStrategy and Coinbase back in January was just too high for me for my taste. And I didn't like Eli Lilly because it was very bearish. Right now, I feel like I can stomach Eli Lilly, but the benefits just increased. So that's why I switched to Harvest. And also, if you watch from a few videos before, I said that I've actually modified my thesis for the long term. I actually want to be safer as my portfolio is growing. Right. I made this comparison a couple months back, where I was talking about how, like, as the portfolio grows, that you want to be less risky. So I feel like buying less single stock funds and buying more, like, basket funds like this HHIS is actually better, as is actually reducing my risk a lot versus going for specific funds. So I think what I'm going to do is, with the $6,000 I have here, I'm probably going to invest in more, HHIS later on, and also S&P QQCL. These are my three top ones. All right, Amazon, I'm okay with this one because that's, one of my favorite stocks in that HHIS basket. But again, I think what I'm gonna do for this one is more like a midterm kind of holding. I think for me, I see, so AMZH follows Amazon stock price, and right now, if you look at Amazon, they're at what's the price? They're at 218. Okay. So I think for me, like, once Amazon gets to about 250, 260, I'm going to sell out of this one, because at 250 or 260, I would have had, months of dividends from AMZH, but also I would have a big, like, gain in my total return. Right now, the gain is only $7, but I think if it gets to 250, 260 in the near future, in a couple months, this gain probably might be, 5%, 10%. And also, I would earn another couple months of dividend, and I'll sell around then, and then reallocate those funds back into HHIS, QQCL, USCL. Okay. So in the future, you may see me with just HHIS, QQCL, USCL. These are the three that I like. So after this, I'm going to talk about ones I don't like in this one. Okay. So Amazon was neutral because, it's a single stock, which is kind of risky, but, I'm going to wait it out because I think I'm going to earn more in the future. So let's talk about ETHY. That's probably the next one that I don't like. The first one that I don't like. So it's Ethereum, and I think Ethereum has just been underperforming. And I feel like, in the past, Bitcoin and Ethereum has always been following one another, but for some reason, this is the first time Bitcoin and Ethereum has kind of diverged this year. Bitcoin keeps retesting all-time highs, and Ethereum has just been sliding. Now, that could be a good thing. That means that, I'm buying Ethereum at a discount, right? Look at the stock charts right now. Ethereum is, definitely not at a high point, it's at a low point. But yeah, I think once I get to, like, definitely past break even, once I, make back some money from this investment, I'm just gonna get out of it, because I feel like that money is at high risk right now, investing in a crypto, and it's not Bitcoin. So I'm looking for a time to get out. I have earned quite a bit of dividend on this, but I'm just looking for a better time to get out. The next one I don't like is HPYT. HPYT follows the bond market. It specifically follows the TLT and a few others, but TLT is a main one. So usually if you watch TLT, HPYT will move in a similar manner. So bonds have not been doing well. TLT is 20-year bonds. So you can think of HPYT being like US bonds, and they're kind of long term. Yeah, so you can see like HPYT moved with TLT today, but you can see that in the long term the charts are very similar to TLT. So why don't I like it? I think, well, before I talk about why I don't like it, why did I buy it initially? Um, in the past, I thought it was good to have a hedge. Usually, the bond market moves in the inverse direction of the stock market. So I thought because I had so much invested in the stock market going up, like USCL, QQCL, all these stocks that go up when the market does well, right? That I need a hedge. What if one day the stock market just crashes, Armageddon happens? I need something to still, kind of prop me up, right? And that was HPYT. But I think my thoughts have changed since then, especially after I did options and day trading. Some important stats that I learned is that like yes, you have green days and you have red days. There's days that the market goes up, but the market goes down. But in the long term, 54% of the time, you're going to get a green day. It's not 50-50. If it's 50-50, then actually it doesn't matter if I buy, market stocks that go up with the market or stocks that go down with the market. If it's a 54%, maybe in the short term, the stocks that go down with the market could outperform the stocks that go up. But in the long term, it's the stocks that go up that's going to outperform the stocks that go down. And that's why I want to get rid of HPYT. HPYT is a stock that goes up when the stock market goes down. And the funny thing is, and I've been holding this for the last year, half a year, when we saw the Trump put, the stock market went down. All the single stocks, all the stocks that go up when the market is up, they all went down. But HPYT did not go down. For the first time in history, the Treasury bonds of the U.S. Government, they went down with the stock market. So I'm just like, yeah, well, that just destroyed all the value that I saw in this before, right? So you have to understand these products and understand these products quite a bit. So the play we're looking for here is when we wait for some interest rate cuts. If interest rates cuts go down, that means the debt of the U.S. government is less. That's when this stock should go up. If we see interest rates going down, 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 that kind of environment is the environment that HPYT and TLT will go up. So I'm just waiting for that day, and then when that day comes, and the stock is at a price where I can get out with a profit after my dividends are included, then I'm out of there. Last thing you may notice is that I have a big stake in this, $66,000. Why that big? It's because actually I was trying to get out of it. I was trying to dollar cost average. So before this, maybe back in fall, I had maybe like $20,000, but I was at such a high valuation. Like, let me see if I can find it. I was probably at like, if I was buying this in September, October, I probably had it in the 1050s, like high tens, probably around there, right? 1092, 1084, something like that. Um, and I think and I've basically just, wait, let me see. Maybe it's even higher than that. Let me go up. Yeah, probably maybe even 11s. Who knows? Probably even a 1104, 1121. So I put more in so that I can lower my average. So I've lowered it to 1071. But at this point, I didn't feel like putting any more money into this because while it was lowering my average, I don't want to put more and more of my money into this. So I've stopped it at this point. And now I'm just waiting for a good pop up. There was a bit of an opportunity like back maybe around May, April. Like, let me see. Maybe there was, yeah. So I remember back in like April, there was this chance to get out around 978. The reason I didn't get out was because I was maybe like $1,000, less than $1,000 of a loss at that point, and I felt like if I just had one more month of dividends, 2 more months of dividends, that I could just break even and get out. Sure enough, that didn't happen, and the market just went down. Right, the stock just went down. So whatever, I'll just wait for the next opportunity. And the next opportunity gets spiked back up because we know, when this happened. Even when this happened, we weren't expecting many interest rate cuts, anyways. But now that we might be close to interest rate cut now, maybe there's a chance in the near future. All right, the last one I don't like before I end this video, I'm going to talk about is RS, real estate split core. I bought into this because I thought, Canadian stocks are at a discount because the economy is so bad in Canada. So I thought I was getting at a discount, and I was in at 12.16. And if you look at, 3, 4, 5, 6 months ago, at 12.16, it was a discount, right? Around here, right? 12.5, it was a discount versus back then. It was that 13s, just a month before that. And if you go even further far out, like it was in the 13s, it was in the 14s, it was in the 15s, 16, 17, 18, 19, right? But ever since I bought in, it just keeps going down and down and down and down. It's just one of those stocks in your portfolio that just utterly underperforms and there's no end in sight. So this one, I'm just gonna have to hold a little longer. So again, something that you're gonna learn about me is that I don't take losses, and this one is not gonna be a loss, and I can make sure this is not a loss. So what we have to do for a stock like this is don't sell. If you sell, then you see the $3,167 loss here in the total return. That's gonna be real, okay? But if you hold, this stock pays you a dividend every month, and the dividend's not going away anytime soon. So over time, that's going to make up for it. And especially if the Canadian real estate market goes back up, that this number will be less, and then the dividends would be at a point where we might actually even take a gain on this. So never sell, in the short term just because something is going down. I've only held this for what, like 4 months, 5 months, like not that long. So 5 months is definitely considered short term. So I can hold it definitely a lot longer, like 2 years, 3 years, 4 years, 5 years. I can hold that long. It won't take 5 years for this to go green for me. I'm guessing, like, from my experience, since I've been doing this since 2021, my worst performing stock since then, it took me about 2 years. So I would say this one would probably take, a similar time frame. So I'm not too worried about that, but definitely feel like if I allocate this money into the US market, it would be better. So in conclusion, these are all the stocks that I own. Um, I'm not going to talk about. Oh, and then, yeah. So before I show you something quickly, these are the stocks that I own. Um, my current thesis is that the U.S. market is where I want to invest in and where I want to put my money into. So I'm trimming away my last Canadian ETF soon, which is an RS. And then once I get rid of a few others, I'm just going straight into three funds: HHIS, QQCL, USCL, and maybe like a Tesla or a Palantir here and there whenever there's a good price. That's what I'm planning to do. And then last thing I want to show you before I end this video, just my dividend income portfolio. I've actually updated this because this is actually available for my Discord community. Those of you who are supported me on Patreon, they can see this, and this is also going to be a great value for you. So everything that I just talked about is all here on this chart, right? All of the different funds I invest in: HPYT, QUCR, RS. You can see how much money I put into it in this column called total investment. Weight is what percentage of my portfolio is in that right now. And you saw what I talked about HPYT. I put a lot in that just to dollar cost average. So it's about 50%. That's abnormal. Okay. It was actually about 10% before I was putting more money into this to average down. So usually I'll put that to 10%, but it's up to 48% because I'm trying to sell this in the near future. So this is the total shares that I have. Based on these shares, I can calculate with the dividend per share what my monthly income is from each of these. So you can see it's 931 for HPYT, and this is the monthly income for all of these numbers. Sorry, for all of these funds. And then if I multiply this out to 12, that is my annual income. Dividend per share is how much dividend I get per share every month. So for HPYT, for example, I get 15 cents every month. I have 6,211 shares. That should equal out to, $931.65. Annual dividend is basically this number times 12. And then using that, you kind of compare to see which one has the biggest dividend. So if you look at all of these, actually the what is this one? YTSL Tesla, before I sold it, actually, I should probably raise that, had the biggest dividend, 6.6 annual dividend. But since I got rid of that, I think my biggest one now is the QQCL. You see how that's at 3.54, it's bigger than 3.06 for the USCL, the S&P 500. So that's could be another reason why you may not want to buy USCL and just go QQCL. But understand that if the tech industry of the US goes down, this one will tank harder than USCL.